Have you ever bought crypto because you were scared you were missing out, or sold it because you thought the market was crashing? What if I told you that emotional decisions could cost you thousands? Stick around, and I'll show you how to avoid these mistakes and build a strategy that actually works. Emotions play a huge role in our daily lives, and they play an even bigger role in investing, especially in markets like crypto, where prices can change by 10% or more in a single day. In today's video, we're going to talk about why emotional investing is a recipe for failure and how you can keep your cool, stick to your strategy, and actually profit from the market's ups and downs. Why emotions are dangerous in investing. Let's start by talking about why emotions are so dangerous when it comes to investing. The main problem with emotions is that they lead to impulsive decisions. Think about it. If you're scared of losing money, you might sell at the wrong time. Or, if you're overly excited about a coin going up, you might buy at the peak, only to watch it crash right after. In fact, some of the most successful investors in the world, like Warren Buffett and Charlie Munger, have been clear about the importance of controlling your emotions. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." And Charlie Munger added, "It's not supposed to be easy. Anyone who finds it easy is stupid." The FOMO effect, fear of missing out. Now, one of the most common emotions we face in the crypto world is FOMO, fear of missing out. You've probably seen it. Bitcoin shoots up 20%, and suddenly everyone is talking about it. People are rushing to buy because they're scared of missing the next big rally. But FOMO doesn't lead to profits, it leads to losses. When you act based on fear, you're letting the market control you. Instead, you need to control the market by having a clear plan. Buying in a panic because everyone else is doing it is a recipe for disaster. The importance of having a clear strategy. So, how do you avoid emotional decisions and start investing wisely? It all comes down to one thing: having a strategy. Warren Buffett says it best. "I always invest with a clear long-term vision. And if I don't understand something, I avoid it." In other words, don't let the market's noise control your actions. You need to have a strategy that includes your risk tolerance, your investment goals, and your time horizon. With crypto, things move fast. But that doesn't mean you should jump in without thinking. Take your time, understand what you're investing in, and make decisions based on logic, not emotion. Long-term focused and patience. Investing is not about making quick profits. It's about long-term growth. Crypto is volatile, but that's not necessarily a bad thing. Volatility can actually work in your favor if you have a long-term view and don't let short-term price swings dictate your decisions. Think about it. Bitcoin is up over 1,000% from its lowest point, even after all the ups and downs. If you bought Bitcoin back in 2012 and held it, you'd have made a massive return. The key here is patience. And as Charlie Munger says, the big money is not in the buying and selling, but in the waiting. The importance of long-term investing in crypto. One of the biggest advantages you can have as an investor is the ability to hold through the volatility. However, with crypto, unlike traditional stocks, there are no guaranteed returns. The market is highly volatile, and while some investors may see large gains, others may experience significant losses. That's why it's crucial to focus on long-term growth rather than short-term price swings. In the case of Bitcoin, for example, it's risen over 1,000% from its lowest point despite experiencing numerous ups and downs. This illustrates the potential for massive growth over time, but it also highlights the risk. What works in your favor, however, is the power of long-term investing and avoiding emotional decisions. Patience and a strong strategy will help you ride out the market's inevitable fluctuations. Don't rely on short-term predictions or aim for quick profits. Instead, understand the market's potential and focus on building wealth steadily over time. How to avoid emotional decisions in crypto. To avoid emotional investing, there are a few things you can do. First, Set your goals and stick to them. Know exactly why you're investing in a specific crypto asset, and don't let market hype or panic change that. Second, make sure you're not checking prices every minute. The more you watch the market, the more emotional you become. Instead, check your portfolio less frequently and focus on your long-term plan. Third, use dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the price. This way, you avoid buying in at the top of the market, and you take advantage of price dips. The key takeaways. Remember, emotional investing leads to poor decisions. The best investors are those who remain calm, stick to their strategy, and invest with patience. As Warren Buffett says, the stock market is designed to transfer money from the active to the patient. So, if you want to make money in crypto, don't let your emotions control you. Have a strategy, stay calm during the ups and downs, and let the power of long-term investing and compounding work for you. Conclusion: investing in crypto doesn't need to be a roller coaster of emotions. By staying disciplined, understanding the markets, and focusing on long-term growth, you can achieve your investment goals. Don't let fear and greed make your decisions for you. Let logic, patience, and a clear strategy guide the way. Thanks for watching. If you found this helpful, drop a like and subscribe for more investment tips on crypto and finance. Until next time, stay smart and invest wisely.